as you know, dollar has been appreciating globally, and it's pushing up the currencies of the emerging markets. And Turkey is not an exception to this trend, but it seems that there are some other factors that are pushing up Turkish lira far more than other emerging markets. So over 2016, the Turkish lira dollar has appreciated by more than 20% in Turkey. It was the same. The same trend was also observed in Mexico, where the dollar appreciated again by 20%. So we can explain this due to global appreciation of dollar. But it seems that since early 2017, Turkish lira started losing far more value than other emerging market currencies. And again, one of the factors is a trend in the global appreciation of dollar. But for example, while Turkish lira depreciated by more than 7% in 2017, the Mexican peso depreciated by less than 5%. So we have to explain this difference, and this difference probably stems from the domestic factors in Turkey and outlook for the future. So in Turkey, probably everyone knows already that there is a constitutional reform process discussions going on in the parliament right now. And it's having negative impact on the political risk factor of Turkey. This is one of the reasons. And another might be increasing oil prices, as Turkey is a commodity importing economy. Its current account deficit is widening recently, so these are pushing up the exchange rate of Turkey. Add to that all these various terror attacks, which are not helping Turkey as well. So we have significantly depreciated Turkish lira recently. Just at that point, I would like to mention that I don't prefer comparing Turkish lira to a basket of all emerging market currencies, given that in this emerging market basket we have ruble and Brazilian Brazilian currency also. These two currencies, for example, benefited significantly from the increasing commodity prices. So we have to separate these commodity importing countries and exporting. So Turkey stands among the commodity importing countries, and increasing oil prices are having negative impact on Turkey. But leaving aside these two factors, in looking at the actual domestic economic developments, we see no real critical development that might have pushed up Turkish lira. So, for example, portfolio flows are positive. After massive outflow in November, Turkey has actually experienced inflow of portfolio investment to Turkey. It was slightly less than $500 million in the 4 weeks ending in 6 January. The same trend is observed in the banking sector. So actual dollarization ratio and FX deposits, foreign exchange deposit in Turkey has not increased over the last 4 weeks compared, whereas in November, when there was a first push to depreciation, there was an increase in dollarization ratio in Turkey of deposits, and there was slight increase in dollar deposits. So basically we can tell that in November, when lira started to depreciate, the factors were that there was an outflow, foreigners were leaving the country, and the locals were transferring their Turkish lira holdings in the banks to foreign exchange. This is not the case right now. However, there is a worsening development in inflation trend. So inflation in Turkey in December picked up significantly. It was 8.5%, far above the expectations. After a long break, Central Bank of Turkey has stated that once again depreciating weaker local currency is pushing up inflation. So we have this, as we said, exchange rate pass-through effect materializing and pushing up inflation. So actually, to put some footnote here regarding the impact on Georgia. So if depreciation of Turkish lira brings about inflation, then in real terms they are balancing each other. So in real terms, Georgian lari and Turkish lira are probably going to stay the same. So there won't be a pressure on Georgian exports or imports. There won't be significant pressure, let's say it like that. And at the same time, central bank has stated that if Turkish lira remains weak, it's going to have a lasting impact in the months ahead on inflation. So that's one of the main negative developments over the recent period in Turkey. Aside from the exchange rate pass-through effect, energy prices are also negatively impacting inflation in Turkey. Up to now, they have not been reflected in consumer price index, but they have been reflected in producer price index. So from late 2014, energy prices globally were going down, and its prices within Turkey were going down also. So it was helping to lower inflation for producers, and thereby eventually it was reflected in lower consumer price index. This trend has finished in December after close to 2 years. Eventually energy prices went up. They're in the positive territory, pushing up producer price index to close to 10%. And eventually probably we will have this development reflected in consumer prices, and so inflation will likely remain high in Turkey in 2017. Actually, there are expectations by some analysts that inflation might be around 10% in Turkey in 2017, and it's going to be a problem for Turkey. For example, it's the 6th year, I think, in 2016 that inflation was far above the target of the regulator in Turkey. At the same time, energy prices are worsening Turkey's external balance. So with the fall in oil prices globally, Turkish current account balance has improved significantly. Even the fall in tourist revenues in 2016 was far more compensated by the lower import bill for energy in Turkey. For that reason, current account deficit narrowed until the mid-2016. But actually, if we take away oil-related imports, current account balance was worsening, and further going in next several months with higher energy prices, probably current account deficit will widen further, and it will increase the financing need, external financing needs of the country, which are going to be challenging given that yields global are increasing, and it seems that Turkish regulator is hesitant to increase the rates to make Turkish lira a little bit expensive in real terms. At that point, I would like to also mention the FX position of non-financials in Turkey. So if you look at chart 7, Turkish open position, FX position of Turkish non-financials is more than $210 billion right now. And it has, if you add to that depreciation of Turkish lira, which was close to 30% over the last 3-4 months, the burden on Turkish non-financials has increased by 30%, basically it means. So this is another pressure. This is another pressure. This is another problem for Turkey to meet these obligations. And if you look at and here I would like to start about this real price of the currency. So central banks are obliged to set the price of their local currency, and they do it by the monetary policy rate. In Turkey, it's 8% right now, and the Turkish central bank has not changed it for a long time, except for one small hike in late 2016. But as inflation surged lately, it means that Turkish real interest rates are in the negative territory. And when we compare to other economies, like for example in Brazil, it's plus more than the difference between policy rate and inflation is positive at more than 6%. The same for Georgia also, for example, it's close to 5% difference between policy rate and inflation. So effectively, higher policy rate than inflation means that your currency is profitable to hold for foreigners. In Turkey, the situation is totally opposite. So inflation is higher than policy rate, and anyone who is holding Turkish lira is losing in real terms. And if inflation persists at this high level, in real terms, holders of Turkish lira assets will be losing going further. How naturally it's expected, and under the normal situation, everybody would expect that central bank would increase the rates in Turkey to support Turkish lira. This is particularly important in the countries who have current account deficit, meaning that they have to attract foreign investment to their country to finance their external deficit, external gap. For example, Mexico, which was the most vulnerable to elections in US, have raised the interest rates 2 times, and maybe that's one of the reasons why lately their currency have not lost that much than Turkish currency. Turkish central bank will hold its next meeting regarding the policy rate on January 24th. General analysts don't expect much significant rate increase, even if there is any increase. But to be effective, meaningful, everybody agrees that there should be really strong hike in the interest rates. So with this not coming, probably the pressures on Turkish lira will remain in place in the months to come. Another factors in Turkey that will shape the Turkish lira's future trend is political development. So this constitutional reform is still in the parliament being debated. It will likely pass the parliament, and then there's going to be a referendum on this issue, probably by late April or early May. So expect this political risk factor remaining in place also, which will pressure Turkish lira. So to sum up, Turkey is facing several challenges. First is appreciating dollar globally. Second one is increase in oil prices, which is burden for Turkey in terms of the external balance. And add to that is political developments. Given that given the conjuncture, there is no expectation that the central bank will raise rates significantly. The pressure on Turkish lira will probably remain in place. Again, to further sum up, I would say that current depreciation of Turkish lira is probably more related with expectations going forward rather than the real actual data. Actual developments, but further weakening of Turkish lira might have a consequence eventually on the real sector. So for that reason, Turkish authorities have to make some decision or to take some action. For example, there is an argument that higher interest rates are hurting real business who have to borrow in local currency and finance their investments or growing output. But it's now the situation right now is that regulators have to make decision which is more hurtful right now to real sector, higher interest rates or higher exchange rates. Since to service their debt, the real sector has to use far more Turkish liras to buy FX to service their debt. So this is the challenge of Turkey. And additionally, I would like to say some words on Azerbaijan. Recently, Azerbaijan approved budget for state oil fund. State oil fund in Azerbaijan is the main supplier of FX to the market. And given that the crash in oil prices over the last 2 years, Azerbaijani authorities decided to consolidate fiscal position, so they cut expenditures. Plus, to that, with devaluations, state oil fund had to sell far less FX to meet its domestic obligations. Eventually, it resulted in less FX supply in Azerbaijan, which was creating volatility and problems in the FX market in Azerbaijan. But for 2017, government has approved budget expenditure relatively higher than in 2016, and they added new item, a spending item, which they call transfers to central bank to support macroeconomic stability. Unfortunately, we don't have much information about the detail of this spending category, but it's assigned more than $4 billion. And personally, I believe that with this additional $4 billion, probably there won't be much volatility in Azerbaijani FX market. So expect a relatively stable manat in 2017. Yes, while in short term it's benefiting Azerbaijani manat, but in long term we have to see how the reforms will proceed in Azerbaijan, since using more reserves means that less is remaining for the future years. But eventually we will see how authorities continue with their reform agenda. And with this additional ammunition, so to say, central bank and authorities in Azerbaijan feel more confident to move to full free float of the local currency. And first step has been taken already. For example, in last year in Azerbaijan, there was 4% cap. It means that, for example, central bank was setting exchange rate, and commercial banks were allowed to sell only up to plus 4% of this rate. So this cap is removed, and banks right now can sell at whatever rate they wish to. And with these reserves, additional transfers from the state oil funds, central bank will have quite enough resources to intervene in the market in case there is a strong volatility. And as we all know, and the example of Kazakhstan and Ukraine is good in that, when at the first stage of moving to free float, the markets face quite a lot of volatility, and the central bank's ability to manage this volatility is important, and the reserves play an important role in here. So to sum up these two countries, probably in the next few years we will have kind of a volatile exchange rate developments in Turkey, but relatively stable development in the FX markets in Azerbaijan. Thank you.